Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, March 5th, 2010. We begin today's broadcast with the big news of the day, which was the non-farm payroll release from the US for the month of February. What we saw was that the economy shed 36,000 jobs during the month, which was a much better figure than the 68,000 jobs lost expected. The unemployment rate stayed at 9.7% when expectations had it inching up to 9.8%. Many analysts were focused on the fact that February had very poor weather and two very large snowstorms that negatively impacted this February release. So it seems that jobs may have even been created over the month were it not for the two snowstorms. The internals show that the manufacturing sector added 1,000 jobs after rising 20,000 the previous month, and while the services sector had an addition of 24,000 jobs. Where we saw the big decline was in the construction sector, as builders shed 64,000 from their payrolls. That had followed a 77,000 drop in January. So it seems that the construction sector is still suffering the most as the economy recovers from its recession. If we take a look at the last 4 months of non-farm payroll on our chart to the right, we see that total job losses are fluctuating around zero. We had growth in November, and now we've had 3 months of small job declines. But things are looking up for the next month, as any jobs that were lost during February should be made up in the March report. In a look at the unemployment rate, we see that what looks to be a bit of a topping here in terms of unemployment. So overall, it was a better than expected report, and it did help equities to rally in today's trading as we ended the week with risk sentiment positive. The biggest reaction to the news was in the dollar-yen pair, which broke above a level of resistance that it had been coming up against prior to the release, right here around 89.40. Following that break of resistance, we rallied about 100 pips until we tested our highs from 2 weeks ago, here around 90.30, and we actually moved up even above that. Zooming this pair out further, we see that we are retracing this fall in the dollar-yen pair, and that today's resistance at near 90.60 was a 61.8% retracement of this downswing. Zooming this pair out even further, and if we connect our highs from the beginning of January with our highs in February, we had this downward sloping resistance trend line that was broken here in mid-February, but then we retested this now as support, and we could see that as we had been moving down in this week's trading, we had been bouncing up off that downward sloping resistance level, and the end of the week saw us rallying rather sharply from that. We also had cleared out the support below this 88.60 level midweek. As we mentioned yesterday, the cost to borrow yen became cheaper than the cost to borrow dollars for banks for 3-month loans. So that means that the yen should reclaim the mantle as the premier funding currency in carry trade. So during the risk appetite today, as we had equities pretty much surging in New York, that helped the dollar to gain. The yen was sold off against many of its rivals, including the pound, the euro, and the Australian dollar. Taking a look at the Aussie yen, we saw a similar dynamic with the dollar, where we had been setting up a period of resistance around the 80.75 level, and we pushed above that in New York trading until we hit our resistance from this area here, where we had topped off a rally in the pair. So we'll see how next week starts for this pair, and if we have higher gold prices and higher equities, it seems to make sense that we would push above this resistance as well. Staying with the Aussie, here we're looking at the Aussie dollar pair, and we see that following the non-farm payroll release, we had moved above our 50-period moving average that we had been testing as support, but then had turned to resistance. But now we have moved above it again, putting this pair into a bit of a bullish mode for today. We moved above our resistance from earlier in the week, our high for the week around 90 from 0.9090, but we didn't manage to push too much above that. If we zoom this pair out, we see that we had a rather strong rally in the Australian dollar throughout this week, and yesterday when we reached our low here on 89.80, we could see that it was a 38.2% retracement of this rally. So that's a rather shallow retracement, and we'll see how the pair reacts around this level, but a 38.2% retracement is usually a pause or correction to a further rally. But again, a lot of that hinges on whether the risk sentiment we saw to end this week extends into next week's trading, as risk aversion will obviously hurt this pair. Turning to the euro dollar, we had, following our non-farm payroll release, we had an initial slide below the 1.3550 area as the greenback gained, but then as we saw the dollar lose ground against most of its other rivals except for the yen, the euro managed to rally. So that returned us to a bit of our previous pattern where a higher risk appetite had boosted the euro compared to the dollar. We hit a high for the session around 1.3630, which was also where our moving average is, and the short rally has stalled out there. So the euro dollar seems to be squarely in the middle of this consolidation zone that it's been in throughout the last 2 weeks, even though we sort of cleared out this above this 1.37 level in the middle of the week. While the situation around Greece has not been resolved fully, and it seems that there will be no financial aid coming from EU countries to Greece anytime soon, we did have a positive market response to the austerity cuts proposed by the Greek government in the middle of the week, which helped start this rally on Tuesday and Wednesday in the euro. And we also had a pretty positive bidding for Greek bond, 10-year bond offering. So we'll see if the risk surrounding Greece lessens anytime soon. In the meantime, we have to keep watching our important support level here around 134.50, and we have resistance if we connect our recent highs and a downward sloping trend line. We see that we tested that level pretty well. So this is our short-term resistance level, so around 1.37. So we seem to be squeezing right now, and that's a sign of consolidation following our very sharp fall in this pair from the beginning of the year. So we'll see whether the markets see what Greek has done is good enough so far, and the euro gets a bit of is able to gain some momentum and to start a rally, or if we fall below this 1.3450, which right now is our firewall for this pair, then we could see a sharper deterioration. So we have to keep our eyes out for news about Greece, and any setbacks could hurt the euro. In our final pair for the day, I just wanted to take a quick look at the dollar Canadian dollar. We had already looked at the Aussie and its strength in today's trading, and as we can see, following non-farm payroll today, the Canadian dollar gained, moving below this 50-period moving average that had flirted above prior to the release, and we hit a new low around 1.0260. So if we take a look back in this pair, we see that that comes close to this resistance in the middle of January around 1.0225. Now this week has seen a very sharp move in favor of the Canadian dollar, especially in the first half of the week, as we had better than expected GDP release here, and then we had a more hawkish Bank of Canada statement. So that had followed this head and shoulders pattern, and we did break below important support, so a lot of bearish signals for this pair and strength in the Canadian dollar. So just like the Aussie, we're going to have to see how investor sentiment shapes up next week, and as well as oil prices. Next week, the docket is rather light for U.S. releases. We'll have on Thursday the trade balance and weekly jobless claims, and Friday we'll have a pretty important retail sales report, and as well as the consumer preliminary measure of March's UMich consumer sentiment. Around the world, we start with some housing data from Canada and Australia. That's followed by manufacturing production from the UK and the Reserve Bank of New Zealand interest rate decision. On Wednesday, we're going to have Australia post its employment change and unemployment rate. Thursday, Switzerland has its interest rate decision. Canada posts its trade balance, and on Friday we get the Canadian employment change. So a mix of releases for the Canadian economy as well as 2 central bank decisions. And that will wrap it up for our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site FXTimes. I want to thank you for watching and wish you a great weekend.